Section 17 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 5, Greater Access to Lending, a business where we can make some money. As private label securitization began to take hold, new computer and modeling technologies were reshaping the mortgage market. In the mid-1990s, standardized data with loan-level information on mortgage performance became more widely available. Lenders underwrote mortgages using credit scores, such as the FICO score, developed by Fair Isaac Corporation. In 1994, Freddie Mac rolled out Loan Prospector, an automated system for mortgage underwriting for use by lenders, and Fannie Mae released its own system, Desktop Underwriter, 2 months later. The days of laborious, slow, and manual underwriting of individual mortgage applicants were over, lowering cost and broadening access to mortgages. This new process was based on quantitative expectations. Given the borrower, the home, and the mortgage characteristics, what was the probability payments would be on time? What was the probability that borrowers would repay their loans, either because they sold their homes or refinanced at lower interest rates? In the 1990s, technology also affected implementation of the Community Reinvestment Act, or CRA. Congress enacted the CRA in 1977 to ensure that banks and thrifts served their communities, in response to concerns that banks and thrifts were refusing to lend in certain neighborhoods without regard to the creditworthiness of individuals and businesses in those neighborhoods, a practice known as redlining. The CRA called on banks and thrifts to invest, lend, and service areas where they took in deposits, so long as these activities didn't impair their own financial safety and soundness. It directed regulators to consider CRA performance whenever a bank or thrift applied for regulatory approval for mergers, to open new branches, or to engage in new businesses. The CRA encouraged banks to lend to borrowers to whom they may have previously denied credit. While these borrowers often had lower than average income, a 1997 study indicated that loans made under the CRA performed consistently with the rest of the bank's portfolios, suggesting CRA lending was not riskier than the bank's other lending. Quote, "There is little or no evidence that bank safety and soundness have been compromised by such lending, and bankers often report sound business opportunities," unquote, Federal Reserve Chairman Alan Greenspan said of CRA lending in 1998. In 1993, President Bill Clinton asked regulators to improve bank CRA performance while responding to industry complaints that the regulatory review process for compliance was too burdensome and too subjective. In 1995, the Fed, Office of Thrift Supervision, or OTS, Office of the Comptroller of the Currency, OCC, and Federal Deposit Insurance Corporation, FDIC, issued regulations that shifted the regulatory focus from the efforts that banks made to comply with the CRA to their actual results. Regulators and community advocates could now point to objective, observable numbers that measured banks' compliance with the law. Former Comptroller John Dugan told FCIC staff that the impact of the CRA had been lasting because it encouraged banks to lend to people who in the past might not have had access to credit. He said, quote, "There is a tremendous amount of investment that goes on in inner cities and other places to build things that are quite impressive. And the bankers conversely say, this is proven to be a business where we can make some money. Not a lot, but when you factor that in, plus the goodwill that we get from it, it kind of works," unquote. Lawrence Lindsay, a former Fed governor who was responsible for the Fed's Division of Consumer and Community Affairs, which oversees CRA enforcement, told the FCIC that improved enforcement had given the banks an incentive to invest in technology that would make lending to lower-income borrowers profitable by such means as creating credit scoring models customized to the market. Shadow banks not covered by the CRA would use these same credit scoring models, which could draw on now more substantial historical lending data for their estimates to underwrite loans. Shadow banks not covered by the CRA would use these same credit scoring models, which could draw on now more substantial historical lending data for their estimates to underwrite loans. Quote, "We basically got a cycle going which particularly the shadow banking industry could, using recent historic data, show the default rates on this type of lending were very, very low," unquote, he said. Indeed, default rates were low during the prosperous 1990s, and regulators, bankers, and lenders in the shadow banking system took note of this success. End of section 17.